Um, my name is Bob Brenner. I'd like to invite everyone to the first session in our annual colloquium series, Center for Social Theory and Comparative History. Thinking about it, we actually began in 1987, which is beginning to be a long time ago. And my arithmetic is being stretched here, but I think that means we're somewhere in our 35th year and still surviving, which is about as good as we can expect. Before I get to the substance of today, for which I'll pass the introductory work on to Kevin Harris for the most part, I just want to mention the death 2 Tuesdays ago of Mike Davis. It's a sign of the times, of some progress, some recognition that I think at this point, Mike's work, contributions, intellectual and political, are being, for the first time, adequately being recognized. And as a result, there has been an outpouring not only of material on Mike, but material organizing further work on the sort of things that Mike worked on, political, intellectual. I met Mike now a half century ago. So did my partner, Susie Weissman. We met Mike separately. We got to know him separately in part, together in part. And it's been a difficult time for us, but no more so, I'm sure, than to many of you. And as I said, it's a sign that maybe it's a sign that there is progress, intellectual, political, personal. As I said, that Mike's passing, as well as his work, as well as his personal connections with so many people, have been finally begun to be properly recognized. I don't mean anything particularly critical in the way I said that. I would have maybe a decade ago, but fortunately, Mike's work has just been too important for people to ignore. Internationally, nationally, in Los Angeles, and at UCLA, where he played a very important role in the founding and development of our center, one of the more trivial contributions he made. So I will stop that there, stop that discussion of that subject now, but just note that we will certainly be organizing events around Mike's politics and intellectual contributions in the coming year. So people can look forward to that. Today, our first meeting, as I said, for 2022, 2023, is on, I'm going to use Mike McCarthy's no, I'm going to call it alternatives to the financial status quo. That's a general subject. We are very pleased to have as presenters today Mike McCarthy and Lenore Palladino, and as discussant, our own Kevin Harris. I will, at this point, sign off for today and pass the mic over to Kevin Harris, who is going to be chairing the meeting, introducing the presenters, and giving his own commentary when the two speakers finish theirs. So, Kevin, take it away.
All right, thank you, Bob, and thanks to your kind words about Mike. And I encourage people who are watching this video now or watching it later to go to some of the recent interviews Mike gave to lots of different media sources in the last few months of his life, including interviews done by the LA Times, which had many mea culpas from writers of the LA Times who admitted that in prior decades they didn't take Mike seriously or disagreed with some of his analyses, but in retrospect, tipped their hat to him and celebrated his contribution to Los Angeles and the intellectual life of Los Angeles itself. Of course, I first read Mike reading late Victorian Holocaust. It's a very different way of looking at the late 19th century. So, well, I think it's appropriate that we hold events and discuss Mike's work and what's coming out of it, what will come out of it. So, last year we spent some of the time at the center inviting in speakers on Zoom to discuss, debates going on the left about essentially, how to analyze, what's going on in the world economy today. And not to take too much credit for it, but we were rather prescient on some of the topics, such as the political economy of inflation, the role of asset holders and the US Federal Reserve and monetary policy, and of course the geopolitics of the new right. This is kind of our focus over the last year. And for better or for worse, those topics have become more and more pressing and actually even more in need of clarity and analysis. So, to push this kind of line of analysis forward, we hope to spend several sessions over the coming year, 2022, 2023, over thinking through, different parts of the world economy under conditions of, insert term here, secular stagnation, permanent long downturn, inabilities of sources of capitalism to increase productivity and growth for sustained periods of time. And whether or not one believes that that's the case is certainly, from many different intellectual sources right now, kind of the prevailing mode of seeing current trends in the world economy. So we'd like to start off the year with a session on finance, given that it's almost in the daily news and daily headlines and seems to be driving a lot of political trends. So I'm going to introduce the bios for our two speakers. Both of them have PowerPoints. I'll make some pointed questions to each and encourage a round of discussion. And then to everyone listening and watching now, we will have a kind of open Q&A in which people will be encouraged to raise their digital hand up to get into a queue, at which point you'll be called upon, and then you can get on video, ask your question, make your comment to any of the speakers. So thanks for coming, and this is being recorded for posterity, because if we're so prescient, then everything we say here must be proven true in the future. So Interestingly, both of our presenters today have chapters in a new book that's just been released on Verso. Democratizing Finance, Restructuring Credit to Transform Society. So just out this year, edited by Fred Block and Robert Hockett, and it's part of the Real Utopias book series that Verso's been putting out, originally edited and coordinated by Eric Olin Wright. So it's actually very exciting that this book's out. Fred's not too far away from us here in LA, and that Mike and Lynn are part of this project. So first, we're going to have a presentation by Mike McCarthy, who's Associate Professor of Sociology at Marquette. He's a current fellow at the Berggruen Institute. His first book, Dismantling Solidarity, Capitalist Politics and American Pensions Since the New Deal, won many awards. And he's working on a new book for Verso, and has a chapter in this new edited volume on finance. And then we'll feature a presentation by Lenore Palladino, who's an assistant professor in the Public Policy School and the Economics Department at UMass Amherst. She's also a research associate at the PERI, the Political Economy Research Institute at Amherst, and a fellow at the Roosevelt Institute, and has written widely on corporate power, shareholder politics, and the relationship between the governance of corporations and labor markets. And she's also got a chapter in this new book. So looking forward to the presentations today. I'll take some notes, we'll have a conversation, and then we'll have a Q&A. So Mike, why don't you take it away?
Sharing my screen here. Okay, all right. Thank you so much for that introduction, Kevin, and thank you to Bob so much for that moving tribute to Mike Davis. I know his loss is as much personal for you as it is political, so I just want to send a little solidarity your way as well. The talk I'm going to give today is part of a bigger project that I've been working on for a while, and it's titled Plunder Politics, Reproductive, Restitutive, Redistributive, and Hegemonic Projects to Undo Financial Predation. And this is going to be the agenda for the talk. First, I'm going to try to talk a little bit about what finance capitalism is as a historical moment in the development of capitalism more generally. And I'm going to tie that, building off some recent work by Bob, to plunder in politics. And I'm going to then get into exactly what are the different means of plunder available to finance capital. How exactly does finance use politics to redistribute wealth and income upwards? Then I'm going to get into the responses that have begun to emerge in the period that we're living in to this kind of plunderous politics of finance. What are the different sort of political projects that have emerged that seek to kind of respond to the financial degradation, the ecological degradation that we see in front of us? And finally, I'm going to try to show that these different projects are in fact different kinds of class projects. They pose different ways of dealing with the crisis of finance capitalism and are essentially the projects of different class interests. So that's the kind of broad roadmap for the talk. Recently, there's been a lot of interesting debate, sometimes somewhat controversial, about the possibility of a return to feudalism or a return to kind of feudal logics in exploitation and extraction relationships in contemporary capitalism. There's three really broad kinds of ways in which the left in particular has approached this question. First, you have folks like Jody Dean and Yanis Varoufakis who think about platforms and the workers of platforms as being a kind of neo-peasantry who own their means of production, but are nonetheless exploited through rents. Then you have other folks like Cedric Durand and Wark who think about data control and a new class of techno-billionaires who are essentially extracting value from their control over data. The perspective that I'm going to try to build on and think about a little bit today is Brenner's, who has kind of begun thinking about how large long-term changes in the accumulation model of contemporary capitalism have really led to a shift towards politically driven upward redistribution, away from market-based redistribution through work, production, and exchange. Now, building on this work, I think we can map out finance capitalism today really in the following way. Again, drawing from Brenner, overcapacity in the global market led to a really long-term decline in the profit rate, which has weakened incentive for firms to reinvest, and at the same time, weakened capitalist accumulation. This has led to this kind of long-term stagnation, long-term crisis of capitalism. Now, I think capital has responded to this accumulation crisis in really three distinct ways. First, there was a worker squeeze that really culminated in the Volcker shocks, but began well before that, in which wages, benefits, and to some extent, worker control of work were cracked down upon. And this proved as a kind of style 4 or 5 decades. But in many ways, this response was a self-defeating response on the part of capital, since it also weakened aggregate demand. So in a kind of vicious cycle, it actually deepened the accumulation crisis of capital and led to what Cedric Durand has called a world systemic productive impasse. This then led to the second response on the part of capital, which is financialization. As that Fordist accumulation model exhausted itself, speculative activity in financial markets and debt servicing have become an additional key source of profits, key source of income. Where in the kind of economics 101 reading of what finance is, finance should basically be a supportive role in production, simply servicing the needs of large corporations. Today, it actually now plays more of a leading role as a sector. This graph is from the GGDC 10-sector database, and it shows gross value added as a ratio of total value added, looking at the US, and we can see that dark line, the solid line rather, is fire insurance, real estate, but also business services. And we can see that as a ratio of total value added has increased pretty steadily since World War II and come to overcome manufacturing, mining, and construction, which is the larger dotted line, making that X shape. We see somewhat similar trend in the UK, although it's more of a crayon shape than an X shape, where we see the, actually that top line is, I don't know, this is coming out strange in the translation for some reason. That top line is actually manufacturing, mining, and construction, and that decreases as we see an increase in fire starting in the mid-70s. So we're seeing essentially in the two centers of global finance, the city and Wall Street, a growing ratio of total value added in both of those national economies. We can also see transformations with respect to the financialization of people's portfolios. If we look back to 1989, The relevant colors here are gray and kind of that orangish yellow. The top 1% held about 20% of their total assets, household assets, in corporate equities and mutual funds. An additional about 8 or 9% in pension entitlements in '89. By 2019, that is nearly 45%. And we see this also in this increase also in the other income deciles, but it's not quite as pronounced. So we see this transformation as well in the assets held, moving towards financial assets and financial products. Underinvestment, on the one hand, and profits through finance on the other, are really made possible. And I think Brenner's work illustrates this pretty nicely through capital's third reaction to the accumulation crisis, and that is political plunder. The only way to keep corporations afloat has been through upward redistribution through politics, tax cuts, bank bailouts, asset price inflation through monetary policy and low interest rates. The COVID-19 corporate bailouts, such as the CARES Act, have all sort of redistributed wealth and income upward. But this plunder is sometimes treated as a bit of a black box. To use an analogy, if one of the preconditions for generating surplus value for capitalists is owning the means of production, then controlling the means of plunder takes on a unique significance in finance capitalism. And what I want to do next then is to kind of explore what are some of the ways that the financial sector, in fact, achieves political plunder. I think there are basically three types, what I call active engagement, structural prominence, and logistical entanglement. Active engagement involves the financial sector, financial corporations directly working in politics to achieve policy change. And there's two kind of sources of which they do this. One is business association, and the other is the use of financial resources in politics. Business associations such as the City UK Finance, the Bank Policy Institute, the American Bankers Association, there are many, many more, basically help the sector overcome collective action problems through coordination, internal coordination, to achieve its ends. And financial resources are used, as we all know, to directly influence politicians and directly influence the policymaking process through lobbying. In the 2019-2022 election cycle in the US, American finance spent $2.9 billion in politics, and that was 50% more than their previous high in the 2015-2016 election cycle. So this is a key kind of means of plunder that the sector uses. An additional source is what I call structural prominence. And this is a combination of the sector's size in the economy, which we already showed has grown significantly, and their capacity for exit from a political territory or from relevant political units in a territory. Size in the economy is hugely important because as a sector becomes larger, there's an increased social dependence on that sector for investment in the economy, and that creates kind of demand constraints. And capacity for exit, or capital flights, capital slowdowns, is important because this can help essentially punish a polity via things like disinvestment. This might be the movement of the selling of stocks, but it could also be the sort of withdrawal of credit to firms that need it. And the final kind of means of political plunder I want to point to, I call logistical entanglement. And this is the way in which the financial sector is actually critical to the ways in which the state, but also non-financial corporations, actually govern themselves. And for the folks that have done the most interesting work on this, if you want to read further, Ben Braun and Daniela Gabor have written some really interesting stuff with respect to central banks in the state. But here, the financial sector plays an interesting kind of logistical role in state policy. So for central banks in the US, the Federal Reserve has used shadow money creation in repo markets as basically an alternative to US treasuries. In Europe, the European Central Bank has been similarly dependent on the creation of shadow money in its monetary policy. So these all kind of create dependencies between the state and the financial sector with respect to simply how the state enacts its programs. We can see similar interdependencies created between finance and the non-financial sector. One obvious way is through debt, through the maintenance of debt for private firms. Now, it's pretty well known that most large firms are self-financing and self-finance through profits, but huge numbers of small and medium firms, what some folks call zombie firms, are overwhelmingly dependent on credit to maintain themselves. And that creates huge interdependencies between them and the financial sector. And it's kind of interesting that we have research that shows that no other sector, more than the financial sector, is supported by the lobby of other sectors when regulation comes its way. So when a financial regulation comes down the pipe and finance lobbies against it, it's highly likely that other sectors outside of finance will lobby against it as well, much more so than it would be for other sectors, which suggests it's playing something of a leading role. Now, this isn't sort of like a clear case of causation, but it seems that this plunder, it pays off. This is from the World Inequality Database, where if we look at wealth and income inequality, we can see essentially since the 1970s that income and wealth inequality in the US have drastically begun to rise. That's that Piketty U shape from his famous graph. And in the UK, we see a similar pattern, although not quite the same with wealth. Wealth has not risen at the same degree as income, but income has seen a significant uptick. So these are signs of plunder. Now we can understand the fallout of capital's three responses, right? Attack on the working class, financialization, and political plunder in all sorts of different ways. And there's really important work that's currently being undertaken that tries hard to think about how these responses have radically reorganized firms, have radically reorganized entire sectors, have radically reorganized the global economy itself. But with respect to politics, I think the key result has actually been a legitimacy crisis of the financial sector itself. And we can kind of see that populist insurgencies on the left and movements of the national right today are really increasingly taking aim at the financial sector precisely because it is a viable electoral strategy. We can see this in polling, in Gallup polls of where they poll about the confidence in different institutions. In 1979, just 9% of the U.S. residents reported having very little confidence in banks, whereas in 2022, it was more than 22%. And it's not simply progressive Democrats like Warren and Sanders who take aim at finance, but it's even Republicans who are taking aim at finance today. 14 Republican attorney generals are currently going after the 6 biggest banks in the US because of their interest in ESG. So this has become kind of a cultural shift with respect to how people think about finance and how people think about banks. And it's become so severe, in fact, that banks themselves and the financial sector itself has to kind of feign reform. So there's been 4 really big responses to what I think of as this legitimacy crisis of finance. And I call these responses normative responses, regulatory, supplemental, and control. Normative responses are most associated with ESG, which if folks don't know, it's environment, social, and governance. Basically standards for investing that institutional investors, individuals, firms will sign up to, oftentimes through the UN's principles for responsible investing, which basically commits themselves to certain kinds of pro-environment, pro-social type of investing. It's all incredibly watered down and vague, but the idea here is that these kinds of efforts in discourse about finance would lead to a kind of voluntary moral self-regulation of the financial sector itself, right? So that's why I call it normative. It's sort of they're aimed at changing the way in which financial actors, financial investors, essentially see their role in society. So that's been one response, and it's actually been the most dominant response, the most widespread, and has had the most support, maybe unsurprisingly. A second response has been regulatory. It's been aimed at using state regulation through law changes, essentially to tap down on some of the bad behavior that has emerged in the financial sector. So things like a return to the Glass-Steagall Act, different macro-prudential rules about balance sheets and risk, breaking up banks that are too big to fail. That was Bernie Sanders' project. Increasing oversight for possible malfeasance and bad behavior. These are all kind of have been supported by different sort of political actors in the US and UK and elsewhere, and have really been kind of articulated as a way of dealing with the plunder of the financial system. Next, we see what I think of as supplemental responses, which are indirect, don't take on finance directly, but rather create new institutions that can kind of crowd out bad financial actors and bad financial practices. So one of the most famous in the US, and I think it's quite famous in other places as well, especially places that have it, are things like a post bank, where you can put a bank inside of a post office. And post offices are in every zip code, and so even areas that wouldn't be banked otherwise would have a bank in their neighborhood, and this could give access to financial services to people who are typically unbanked. But there's also the idea of creating public banks. Here in Los Angeles, we have Public Bank LA, which is part of a larger public banking coalition in California. And the idea is to create municipal banks that can invest in financial inclusion and sort of infrastructure and other things. And then you also have ideas like creating sovereign wealth funds, creating large national funds that can do things like invest in sort of green retrofitting and national development, and might even sort of do things like give every citizen a universal basic dividend. And finally, we have control proposals, proposals that actually aim to directly control financial institutions and pools of finance. And so we've had notions. This was in the UK of inclusive ownership funds, which would be created in workplaces above a certain size, which would basically, over time, slowly give control to the workers of those workplaces, a bit like the Meidner Plan. We have labor unions in the US and UK incredibly interested in working with their pension funds to sort of think about how they can redirect investment, but also use those funds to have a greater say in shareholder meetings. We've even for the briefest of moments, although it seems off the political agenda a bit today, after the 2008 crisis, there was even talk of bank nationalization, or permanent bank nationalization. There was in effect bank nationalization, but the banks were privatized afterwards. And even central bank democracy, including some mechanism for popular say in the way in which central banks govern the economy. So these have been kind of the main responses. Now I want to just end. About 6 minutes left. So I want to end by just thinking a little bit about how these responses are in fact different class projects. We're in a time which is a confusing kind of political soup. How do we make sense of where we are and where we're going politically? We're kind of in a post-Corbyn Sanders moment where there's a bit of disorganization and uncertainty, yet a sort of still quite palpable legitimacy crisis for capital. And I think these different projects point, in a way, to different paths, different class paths that are essentially on offer. I think they have kind of different hidden class logics. And I think these class logics become clear when we consider, I mean, I'm going to do it very briefly right now, but when we consider two factors. One, their capacity essentially to seize the means of plunder that the financial sector has in democratic politics today. And two, their capacity to overcome the source of the accumulation crisis, underinvestment. Now, I think normative projects essentially do neither of these things. They neither address means of plunder available to finance, nor the underinvestment crisis. And in fact, simply reproduce the financial status quo in a way that's palatable to the green turn in public discourse. And so I think of these as a kind of a reproductive class project. In fact, their sort of aim, whether intentional or not, is to reproduce the existing financial system that we have. Regulatory proposals that have been circulated, again, don't really address the means of plunder or underinvestment, and rest on a peculiar class logic that I term restitutive. I'm kind of riffing a little bit on Durkheim's notion of restitutory law in Division of Labor and Society. Essentially because what they offer, what a lot of the regulatory proposals offer, is a restoration of the macro financial system to its former post-war glory, right? They're trying to sort of turn banks into what they were in the 1950s and 1960s before they changed. But this, of course, is a fantasy, since the post-war boom itself was premised on incentives to invest, which simply are no longer present. Supplemental programs, the supplemental project rather, is somewhat mixed with respect to its ability to seize the means of plunder, if you want to use that language. Were public banks large enough, they could sort of weaken the structural prominence of private banks and private finance. And they might even invest in ways that could sort of run counter to capital flight had they had that sort of intention in their design. But few of the projects for public banks are actually articulated at this large scale. In fact, many of the supplemental projects that are out there don't really try to overcome the underinvestment the underinvestment crisis. Instead, I term these redistributive because they're more aimed at redirecting credit, redirecting investment, redirecting financial services into areas that have been historically marginalized in the financial system. And these include both human beings, so people that are literally unbanked and don't have access to financial services, but also sectors, also types of things to invest in. It might be green technology, retrofitting, the whole green finance complex that has emerged. Now, while these plans address real problems and indeed are important, critical even, they don't really offer a sort of a way to move beyond finance capitalism. Now, just to end here, control, I think, most directly seizes the means of plunder available to banks, especially bank nationalization and central bank democracy. And I think of control as actually part of a hegemonic class project, because they prefigure a new mode of accumulation that brings wider publics into the decision-making process about the allocation of credit and investment. They in fact try to, to greater and lesser degrees, if you look across them, to try to democratize finance. They help articulate a new, what Gramsci called general economic interest, and subordinate the private financial sector and its actors to the needs of the public and other sectors of capital. Now, it shouldn't be any surprise that in politics, control, the hegemonic project has the weakest support, and the reproductive project has the strongest support. But that I don't think should be any discouragement to kind of boldly putting our energy where it's going to be most where it's most importantly going to move the political needle in a direction beyond this underinvestment crisis. And that is I think in projects of financial democracy and control. Of course, I haven't talked about the feasibility and achievability of any of that, but I'm totally out of time, so I will stop there.
All right. Thank you, Mike. All right, thanks. What a coincidence, we're out of time right before the feasibility question. So let's turn to Lenore at UMass Amherst. Lenore, floor is yours.
Great. 1 second. Let me just get this screen share going and put the link. So I have a presentation which you can also access through the website that I just put in the chat. I'll also share it here, but this way, I know sometimes it's hard to see things when you're on Zoom on a small screen. So I've got the link for you there as well. Can you see my presentation, Potential Benefits of a Public Asset Manager?
Yes,
yeah.
Looks good.
Thumbs up.
Looks great.
Great. Wonderful. Well, thanks so much for having me today. It's really great to be here. I'm a big fan of the work you all are doing, and it's fun to get to join you and think bigger picture about democratizing finance. So I'm glad to follow Mike, you're going to hear some repetition between his work and mine, but that's the key to good development, thought development, I think. So I'm happy to follow in his footsteps. So I am an economist at the University of Massachusetts Amherst. I've been doing a bunch of work on different elements of the financial sector and its impact on labor, its impact on corporations, and have been getting more and more fascinated, like many folks, with the rise of the asset managers and thinking about what we might actually do to, achieve in Mike's schema control over the funds that currently private asset managers, your BlackRocks, Vanguards, and State Streets are today in charge of. This work is very much a work in progress. I'll be looking forward to comments, but the goal for me today is to discuss several of the ways in which the financial intermediation chain is broken, including the process of financial extraction that currently is happening from non-financial corporations, and then look at the other side of the chain too, how retirement income, how retirement security in the United States and around the world has become dependent on finance, and how asset managers have really put themselves right in the middle of the chain in order to maximize their extractive potential. So this motivates for me this idea that's very much again in development, a proposal for a public asset manager. One iteration of it right now is to be a public option for public pension fund assets, though of course we could expand it to private pension fund assets as well. But I'm thinking about this just as one of the many changes needed to the structure of finance, but one that also allows us to think about how the current chain hurts both businesses and households. So I tend to focus on policy development, hopefully from a structural perspective, but I'm also often in the plumbing of financial regulation. I'll be sharing some of that perspective today. So if we start out, I put this visual here from Ben Braun, who is a friend of many of ours. We need to think about the financial intermediation chain, I think, from start to finish. And he has a great visual in a recent paper called Asset Manager Capitalism as a Corporate Governance Regime that shows us this very complex system in terms of how we understand household financial assets, often in the form of tax benefited retirement assets, are moving through this very complicated chain to reach corporations. He refers to it actually as an equity investment chain. I've retitled it as a financial intermediation chain because I think it's actually a mistake to refer to this process as investment. I think it makes us very confused about what the role of shareholders actually are in the system today. So but it's a nice visual to help us kind of get a little bit of a landing about where we're going. So I want to talk about three broken links in the chain. The first, what's happened to corporations, and Mike obviously spoke to this as well, to what's happened to their ability to be innovative enterprises, to function as, as productive rather than the current corporate governance regime of shareholder primacy that has enabled and really sped up extractive finance. So I'll talk about that. Two, I want to talk about the broken link in the retirement security side of the chain, where we have really enmeshed retirement financial assets by both public and private workers in this system of shareholder primacy. And what that has meant for retirement assets is, quite simply that our the responsibility of finance to us as holders of these assets has been defined as increasing their value as quickly as possible, damn the consequences. So that's another broken link in the chain. And then a third that I'll talk about is to really focus in on the rise of asset managers, the consequences of granting them legal title, meaning voting power, within the system of shareholder primacy, even though we as the economic beneficiaries, the people who hold the retirement assets, are hurt by the decisions that they make. And all of that is, there's obviously so much we need to do along the entire chain, but one idea that I will then close by talking about that's the paper that is available for this workshop is the idea of a public asset manager. So really control over public pension fund assets by a public institution and a public option for private for private pension fund or private household financial assets. So we can get into options for structuring it. So let me start with the first broken link. So, corporations are non-financial corporations as producers of goods and services. What has happened, obviously, this will be familiar to most people, I think, but over the last 50 years and in a particular iteration, we have seen corporations as defined as simply nexus of contracts, right? Rather than being economic entities that should be shaped by the public as entities that are productive, and we can think about the public policies that might enable their productivity and innovation. They have instead been defined by a neoliberal corporate governance regime as simply nexus of contracts, which means that they simply should exist to maximize the wealth of shareholders. So this is Milton Friedman's famous statement in 1970, though he's certainly not the original author of this idea. And even the Business Roundtable, fast forwarding to 2019, we had this interesting moment where the Business Roundtable, the leading trade organization of large corporate CEOs, said, oh, we need to move on from shareholder primacy. We need to understand corporations as owing responsibility to their stakeholders. Even despite that, corporations have still, of course, stayed within this neoliberal model and acted, more and more in the pandemic to increase the wealth of their shareholders. So this just sort of sets the stage as one broken link in the chain. Corporations are using finance. I pose this as a question, but I'll make it a statement here. Corporations are engaging with finance not to improve the potential for production and innovation, but instead shareholder primacy has enabled extraction by a predominantly white and wealthy elite set of households in the United States. So how does this work? There's lots we could talk about here, but let me just check. Can you see as I'm scrolling? Just want to make sure that you can see as I'm moving.
Yes, you can.
Okay, great. So, at a very sort of simple level, corporate profits are up, lots of discussion about this topic right now, but over the last, especially most recent decade and really over the last 20, 25 years, they've been utilized predominantly for shareholder payments. So I've been doing some work for the last couple of years on the corporate financial practice of stock buybacks, which I'll talk about. But these graphs show you simply that even as corporate profits rise, the ratio of quarterly buybacks to net income or profit and loss has also continued to rise. And we've seen a steady increase over the last decade or so in spending on stock buybacks. And I think I've done a lot of work on the policies that could help us curb stock buybacks, not because I think doing so would be a particular, to use Mike's term, sort of means of, control over the financial sector, but because I think they're really just an insane practice that we allow at this point, and there's really some opportunity for very near-term and feasible, potentially feasible interventions. They're sort of a good symbol in understanding how the system has gone so wrong, right? So what they are is a means in which corporations buy back their own equity that manipulates the market price of their stock on the open market. It also enables corporate insiders, who are the ones who authorize stock buybacks, to personally enrich themselves in the time period between which they use corporate funds for stock buybacks, and they have to disclose that they've done so to the public. And of course, most importantly, they're a use of funds that moves resources out of a potentially productive sector to an extractive sector. So a couple more points on this. Obviously, we know that share ownership in general is extremely concentrated. We also know that it's a contributor and a result of the racial wealth gap, because the holdings of stock ownership have gotten even more concentrated over time. And we know in particular that it's been a means by which corporate CEOs have kept potential activist shareholders happy when they were worried about losing their job. So it's been one of those practices that I think really shows the broken links in the chain. So there's, I think, as Mike again mentioned, we've been, I think, aware for a long time that the idea that finance is supporting the productive capacity of non-financial corporations is incorrect as a matter of sort of the empirics of what is actually happening. So I have here a graph from, again, Ben Braun just put out a recent great new paper that shows the financing source that corporations are funding themselves predominantly through internal funds. Bill Lazonick has been saying this for decades. Many other people have been focused on this for decades. But we have, on the one hand, this empirical reality that corporations finance themselves through internal funds. And then we don't have a picture of it up here, but we also know that for corporations that trade on the public stock markets, they've actually been a net, they have negative net issuance of corporate equity for the last 20 years, meaning that funds are moving out of the non-financial corporate sector faster than they're moving back in. And so the upshot of all this to me is that we need to be really clear that shareholders are not investors, right? That when we talk about what shareholders, the role they play and the challenges we have with shareholder primacy, that at this point, they are not predominantly supporting any productive activity within the non-financial sector. And that's, gives us, I think, very firm grounding to challenge corporate governance ideology of shareholder primacy that has constructed the activity of corporations to be solely in service of increasing shareholder wealth. So I have a blog post that I wrote that I'm currently working on expanding. And by the way, this is one of those, I think, errors, I'll call it an error, that I see even a lot of critical finance friends make, to continue to refer to shareholders as investors. All right, so let me briefly talk about, that's the business side. On the other side, for households, we've also ended up in this situation in the United States where retirement security is bound up in shareholder primacy, right? And it's worth us remembering and stepping back that, we have other options available to us in terms of establishing security for people after their years of work than simply, moving all of their funds into what are very speculative and volatile stock markets. So it's worth just, of course, starting with the fact that we have very unequal access to retirement plans. So 62% of people have any access to defined contribution plans. Only 25% of us have access to defined benefit plans. And of course, the majority of that these days is public sector workers. So it's an unequal system to begin with. But for our purposes, I think what's more important is actually understanding the scale of retirement financial assets and how they've been moved into the hands of asset managers to understand this idea of what a public asset manager might be able to do. So what I focused on up here is first, this first graph tells you the total scale of US retirement market assets, but I want to focus in on the public workforce retirement funds because I think that's actually where the most sort of potential for, I don't know if it's feasible, but a sort of real utopian sense of where we might be able to get to first in terms of the value that a public asset manager could serve. It could serve the public workforce by ensuring that public worker retirement assets are not invested and channeled in a way. See, even I just used it. I used the word invested, right? It's hard to break these habits. That they're not channeled in such a way that they are, killing our ability to live on a decent planet, killing our ability to live in a society that's not more and more stratified. So there's two really pots of money that the public pension that are sort of public worker retirement assets. The first is the thrift saving plan, which serves the federal employees as well as the military. It's got 6.5 million participants. Currently 3.9 of those are working and the rest are in retirees. And it has about 600 billion in assets divided up in a relatively simple set of funds. And even though it is a federal public sector worker retirement account, it has delegated management of its assets to BlackRock. Now, the fees that it pays to BlackRock are much lower than what most private funds are able to get because of its scale. but it's still, I think from the perspective of probably everyone at this event, the fact that we have delegated to BlackRock the management of our federal public sector retirement assets to the tune of billions and billions of dollars is pretty ridiculous, especially when you consider the fact that the funds are held in really just passive vehicles that simply match the S&P. And so I'm very curious about what are they doing? What is the purpose of this? How is this justified beyond just whatever BlackRock says, whatever value BlackRock says they're enabling? So as a second matter, we have about 6,000 public sector retirement systems in the US, state as well as many municipal and federal. I'm a member of one as a public sector employee at the University of Massachusetts. They have in total about 4.5 trillion in assets, with about 300 billion distributed annually and about 14.7 million working members, which is, a sizable chunk of the labor force. I put in here some graphs that are probably, excuse me, I'm still getting over the flu, so I'm going to lose my voice in a little bit. I have some graphs here that are hard to read on the screen, but you can look at them later. They're from a data source called Public Pension Funds, which gives a lot of sort of summary data about these state and local pension funds. But you can see just the scale of their growth over time in the graph on the left, which is simply a visual of their assets over time. And then on the right, I have a picture of asset allocation, which shows that, even though I think there's been a lot of discussion about the movement of public pension funds into what we often hear is referred to as alternative investments, which really means anything that isn't a publicly traded asset, equities still dominate, right? And so the holdings of public pension funds are still very concentrated in that sense. I made this point earlier, but, first of all, it's, I think really important to be very clear about, how stratified holdings of retirement assets and holdings of corporate equity are overall. So I did a paper called The Contribution of Shareholder Primacy to the Racial Wealth Gap that looks at the rising importance essentially of shareholder payments to the overall gap in assets by race, in financial assets by race, and how it's been an increasing contributor of the racial wealth gap. And that's certainly part of the story of what's happened with retirement security. And it's also just, important to be really clear that through the, even as retirement assets have increased, they have become more and more delegated to institutional investors, to asset managers that are in many cases holding assets as legal title, but are not the economic beneficiaries, meaning their value, their profit comes from the fees they're able to get from those of us who actually hold the retirement assets with some hope of security. So the broken link number 3, then along came the asset managers, right? We've always had asset managers. We can go back to the structure of the trusts and JP Morgan. So this is not new in a certain sense, but the rise of the current crop of BlackRock, Vanguard, State Street is, I think, something that a lot of us have been paying a lot of attention to. And I think there's, a lot of reforms being, discussed or floated in terms of the role of asset managers in the financial system. It's important to start out by being, really clear about what their legal fiduciary duties are today to, again, simply maximize the financial returns as quickly as possible, even if, and this is, David Weber's work, who's a law professor, even if, for example, they're investing workers' retirement funds in a company that's trying to outsource the jobs of those very same workers. So there's reforms we could try to focus on about their fiduciary duty. There's also, I think, growing recognition among, lots of mainstream economists and people in the legal academy that asset managers are extremely concentrated. So there's growing attention to what's often referred to as the big 3, BlackRock, Vanguard, and State Street. And so there's proposals floating around about, dealing with problems of what's often referred to as common ownership, or the fact that they tend to end up holding concentrated, or they tend to end up holding large shares in, putatively competing companies in different sectors. And they also, have tremendous voting power. This is another part of the result of their rising concentration has been they've been increasing their holdings and therefore their disproportionate influence over the voting process. And again, I'm postulating as a sort of first instance that shareholder primacy is really a incorrect way of understanding the corporation, but that is the corporate governance regime that we're in right now. And so it's important to understand how their voting behavior has increased, or their voting power has increased, and then to understand how their behavior has changed or not changed over time. So a particular area to focus on is, of course, what's their role in climate catastrophe. If you again think about the idea that asset managers are fiduciaries holding legal title, or holding they're supposed to be responsible to those of us whose financial assets they're holding in retirement funds or other funds, we might think, okay, one way to understand their responsibility is to be proactive in getting us out of the very worst futures that we can imagine with the climate crisis. And unfortunately, of course, you would be mistaken in thinking that they would act that way. So they continue to be major holders of the carbon majors, right? The largest greenhouse gas emitting firms. And this is a great set of charts from a really great paper called From Passive Owners to Planet Savers that shows the breakdown in how much voting power, the three largest asset managers have right now in the carbon majors. And we might think, okay, if they have the interest in mind of retirees, they might at least support some, nominal or sort of simple shareholder proposals dealing with climate change, but that's simply not the case. And Mike mentioned a lot of the kind of brouhaha right now about ESG, whether or not ESG funds act any differently from other funds, I think is a really open question. I also think that they, this pushback that's come against from, state Republican state treasurers and state fiduciaries who are saying, oh, ESG is so destructive. And, it's really caused the asset managers to back off of even their lip service in support of doing anything about climate change. So I just put up here a tweet from journalist Kate Aronoff last week, who was at a event and, caught or captured this person who's the head of public energy equities for BlackRock, basically saying we'll need fossil fuels for decades and decades, right? So what are they doing? They're furthering their holdings of carbon producing companies. They're not voting in favor of really any of the most, so many of the proposals that are coming forward are just for disclosure, or what I would think of as pretty, weak attempts at supporting any kind of real substantive energy transition, but they're voting even against those. So in sum, this rise of asset manager capitalism has really furthered the problem of household retirement assets, not only not serving productive capacities of non-financial corporations, but has further entrenched us in retirement, in shareholder primacy, and in a climate crisis. So what do we do? I started out saying that, I'm someone who spends a lot of time thinking about public policy and trying to imagine what are the types of reforms that we could, really dig in on and imagine creating, current political feasibility notwithstanding. So one idea is a public option for asset management. So there's really two components of this, and I'll close on this section. The first is to, again, think about reforming or rewriting asset manager fiduciary duties. So again, asset managers are, entrusted, that's sort of their function as fiduciaries, with the holdings of households, holding retirement assets. And their fiduciary duties are currently structured in such a way that they can basically argue they have to vote in favor of excessive stock buybacks because they manipulate market prices. They have to keep portfolios invested in fossil fuel companies because that's where the returns are. So we can think about reforming fiduciary duties. I think we could rightfully question how impactful a change in the language would be versus changing everyday practice, but that's at least one proposal to consider. And then a second, which I have a working paper up, which I've linked here in the presentation, is to establish a public option for asset management. And right now, if you are a public pension fund and you want to make a choice to, change your portfolio to remove yourself from fossil fuels entirely, which, some public pension funds and public fiduciaries like Brad Lander, the Comptroller of New York, and other places, they've been doing that, but they don't have an asset manager to use. And for all the rest of the 6,000 state and local pension funds, there is simply no option today that would have that would enable public workforce retirement assets to be channeled in such a way that would not have these extreme negative externalities. I think there's one way to think about this proposal that's explicitly focused on the public sector workforce. There's also, I think, a broader proposal to think about a public asset manager as a public option within the broader sector of asset management as a tool to really take on some of that concentrated power, to act as a nonprofit or as a with a public interest standard, meaning they would be able to have different decision making, different decisions, and to have a different kind of approach to fees and returns. And the final question that I'll just leave open for now, and people like Mike and many others have thought a lot more about this, is what would be the right kind of governance? How do we think about the realities of what we've seen in the last many decades of how worker financial assets have been governed? A lot of that has been, I think, extremely challenging. And so we want to, I think, consider in developing this proposal what actual governance structures might be best as part of a larger reimagining of having public control over finance and the larger financial intermediation chain. So again, I left out so many things I could say, but it's great to be here with you all, and I very much look forward to the discussion. So thank you.
All right. Thanks. All right, we have about 10, 15, maybe 20 minutes left. I don't want to take it too more, but so I'm not going to go into some lengthy exegesis here. The talks were both very clear and posed food for thought. So I want to get the audience to be involved. But I do want to just maybe lay something on the table, which maybe gives us something to talk about, and it ties these together. So over the last couple of years, in the U.S. And to some extent in Europe, there have been these kind of three arenas in which policy debates have occurred that all of which had a kind of implicit or explicit claim that state-driven investment in these policy arenas could be possible sources for rekindling a kind of new cycle of economic growth. One is kind of social policy, health, and education, especially in the wake of COVID. Obviously, the United States has been big legislation passed in some of these arenas. Another is, again, these overlap, but I'm just trying to keep them separate. Another is kind of environment and energy adjustment with regards to housing and transport, agriculture, as well as manufacturing. And the third is this kind of new national security fixation on manufacturing. Well, not new, but reborn national security fixation on manufacturing, both the United States and elsewhere, which kind of ties into the geopolitics of the world economy right now, where manufacturing is seen as a kind of agent in national security. And commodity chains and production chains need to be kind of moved or should be moved either to allies or within the domestic territory. I think the term for this in the Financial Times I saw was friendshoring. And this will allow democracies to upgrade production on the technological frontier, which both drives growth at home, but also secures the home front abroad. Not my language, theirs. All of these, are kind of, big parts of policy debates today, but very little of the discussion I've heard involves the role of finance. So maybe I'd like to throw it out to both of you that, would finance be more of a handmaiden or midwife in these kind of three broad arenas of possible economic and social transformation that have been, debated on the left for a while now? Or are they more sources of, kind of rentier predation, where they can assume control or actually sideline the transformative possibilities, even if the legislation is there and the state seems to be willing to put resources in that. So some of this goes to the kind of the governance changes that Lenore put up, but I just want to put those out there on the table. Feel free to address them or not. So maybe let's go to a first question too. So we'll take Conrad. Conrad, you state your name, what you're doing, and your question.
Hi, my name is Conrad Jacober. I'm a PhD candidate in sociology at Johns Hopkins, and I'm studying financialization. So these two talks were really excellent and really exciting to hear the work that's being done on it still. So my question's mostly for Mike, although I want to draw some on Lenore's presentation. And I was wondering, how would you contrast the current conjecture that you were discussing with that of the early 20th century? You mentioned Glass-Steagall in one of your slides. And so I'm wondering how you compare financialization to what preceded it when Lenin and Hilferding were writing, and perhaps what are the differences in the current conjecture mean for possible responses to it as contrasted responses to financial expansion in the early 20th century. And the next question I had quickly was, how does the secular stagnation thesis respond to the graph that Lenore showed of corporate profits that are currently, according to that graph, going gangbusters during the period of financialization? Where do we see stagnation in that? Yeah, thank you both again.
All right, let's just maybe Michael and Laura, your thoughts on Conrad's question and my provocations, and then we'll take another round of questions.
Do you want to go first, Lenore? Or? Okay, I'll take a stab at that. Oh, right. Yeah, those are really interesting points for discussion. I guess I would say just first on Kevin's kind of provocation about the role of finance and these different kind of areas of investment or allocation, to not use the investment word. I think I maybe have my take on it is I think that finance can have a much larger political role than simply about choosing places to allocate resources. I think that the allocation of social investment, if kind of constructed in the proper kind of governance, could have a massive political role for democratizing the economy, democratizing where we sort of how we sort of create a development model, and how we invest our own income. I mean, I'm of nationally, I'm of the view that that democratizing finance isn't simply about subjecting private financial institutions to public ownership, but rather about sort of bringing ordinary people into actual decision-making processes about allocation of investment and credit. And that's that's obviously a very big and challenging issue, because finance is a highly complicated and technical thing, and the work that banks do, average Joes off the street aren't just going to jump in and be able to decide what firm or what sector is more creditworthy than another. But I think that there are political mechanisms available to create institutions where we could actually imbue public finance with democratic processes. I'm really excited about the idea of randomly selected bodies of residents who would basically serve on boards that could oversee and manage pools of investment and credit that, you know, the jury system has a pretty negative reputation in the US, but one of its real positives is that it brings people into a kind of a shared decision-making process. And, you know, as long as you're not on a really nasty trial, a lot of people leave those experiences actually feeling like they've done something civically and that it's a meaningful experience. And I think that finance and public investment kind of has that, it has a much more positive democratic potential to bring people together, essentially to manage pools on behalf of the whole. That I think it's politically bigger than the decision about where they actually allocate the investment. So that's basically just my thoughts on that. Admittedly, kind of thrown together. Kind of just to very briefly on Conrad's point. This is a very astute question and a challenging one because I don't have a comparison in my mind ready to give you. But I think there are a lot of similarities between the period that we're in now and the period that preceded the New Deal. And I mean, actually, you know, we keep on mentioning Ben Braun, but Ben Braun has actually talked about asset managers recently and uses the Hilferding framework to kind of think about how they've increasingly infused with non-financial corporations in a way that is very similar to how Hilferding was talking about the exact period that you're talking about. I think one of the key differences is that we live in a different global macro financial regime. That sort of the post-war period that the New Deal seems to have produced wasn't simply produced by the New Deal, but it was produced by geopolitical context that sort of made American growth and sort of the growth of Japan and Germany and other Western European countries possible. That isn't really the conditions aren't there today. And so I think one sort of faulty thing we could do is to say, well, the period of the 1920s kind of looks like the period today. Therefore, we should have if we have a similar policy reaction, return to Glass-Steagall and all that stuff, then we'll simply have the sort of post-war boom again, which I think is a kind of a faulty historical analogy because the global conditions are very different today. I've already talked too long, so I'll leave your second question. Maybe we can talk offline about it.
Lenore, do you have any thoughts?
Yeah, I'll just be brief. One just side thought is yesterday with the victory of Lula in Brazil, I was telling someone about going to a public budgeting session in Porto Alegre in Brazil as part of the World Social Forum like 20 years ago was one of the things that got me most interested in finance. So I would highly recommend, if people aren't familiar with its public budgeting, participatory budgeting, I should say, how it's done around the world. It's useful in terms of just pushing your imagination away from those of us who have grown up in the US context and like, that sounds like, how would that even work? It works, imperfectly, but really important to know about. And, sort of getting at your point, Kevin, I'll just say one other thing, where some of this work came from for me in terms of thinking about asset manager a public option or a public asset manager, an asset manager of fiduciary duty, I do believe that we need public control over investment, particularly in the sphere of an energy transition requiring, massive industrial policy. And, the question becomes, okay, if we're doing that, what do we do about the trillions of dollars of public worker, or really all of our financial assets that are currently sitting in these funds? So in other words, kind of the thought experiment, if we had a massive Green New Deal, if we had, President AOC and we were enacting the Green New Deal, what do we do with the household financial assets so that they don't actively work against the type of public investment that we're trying to move forward? And I'll just bring that tension to the near term, something, as I mentioned, I do a lot of work on sort of like financial plumbing policy, and talking to policymakers about the industrial policy programs like the CHIPS Act and other pieces that we've seen come out over the last year. I have been trying to really make the case that it's not just an academic question to think about accompanying important industrial policy to get us, anywhere towards the energy transition we need to, survive. It's not just an academic question to also be really clear about the types of policies that need to be put in place at the same time to limit, extraction by asset managers, by shareholders in the name of shareholder primacy. So an example of this is, when the CHIPS Act came out, and as the Department of Commerce is putting out its policy framework for how it's going to actually, engage with semiconductor companies, they have put in some language now about limiting stock buybacks that, again, like from the perspective of a broad left agenda is pretty narrow, but from the perspective of pushing this framework into into discussions about public investment, to me, it's important that those of us who are thinking bigger picture keep these tensions in mind in the near and medium term.
Thank you for.
And I wish I had a good thought about the early 20th century. I have a little bit of writing about it in my working paper. I've learned a lot from my colleague David Kotz and plenty of others about what happened in the early 20th century, but it's a pretty different time. So it's hard to be concise with a comparison.
So we have a hand up from Kevin Scared. Kevin, you've been waiting patiently. Turn on your video if you like and ask a question.
Thanks, Kevin. I'm going to leave my video off. Unfortunately, I came down with COVID, so I don't look very good right now, but I did want to ask a question. First of all, just thank you very much for the organizers. This is a fantastic subject. We need a lot more like this, and thank you to Mike and Lenore. Great presentations. My question, I have many questions, but I'll only ask one simple one. I appreciate Lenore's focus on a public option for an asset manager. Just to say, up in Canada, I'm based in Ottawa, and I should have said I'm a researcher for a public sector trade union focused on pensions. And in Canada, we have very large pension funds and an enormous now public pension fund for our public pension plan, Canada Pension Plan. And it now has assets of over $500 billion. And unfortunately, even though it is structured as a publicly owned company, governed and board is appointed by our federal cabinet, they've embedded in its legislation very rigid fiduciary obligations to maximize return, all these legal protections. And so it has become, in my view, one of the most predatory pension funds in Canada. Just an example, recently buying up the water utility in Rio de Janeiro in a privatization deal set up by Bolsonaro himself. So it's a really shameful story in Canada. And I just want to put that on the table as an illustration. I'm sure this is not what you have in mind by a public asset manager, but I wanted to put it on the table just to kind of review the kinds of things that we can't allow if we're going to set up a publicly owned asset manager.
Yeah, I would just say absolutely. I think that's I'm going to follow up with you, and I see you have a book here that I'm certainly going to read. I think the question of how union and public pension funds over the last, couple decades have increased financialization, have, increased all this drive, even, it's full of contradictions. And there's a lot of very, people who I respect a lot working in places like Union Capital Strategies funds who are dealing with this tension of under the current legal setup that we have for fiduciary duty and just the deep embeddedness that we have in the current financial system. They are in many ways furthering shareholder primacy, even as they are also, doing things like using their shareholder voting power to, try to pass pro-worker or pro-climate shareholder policy. So that's, I think, really important. And I should have started out by saying that, that I feel unfortunately very limited to only being able to really talk about the US context because it's what I know, but I think there's a lot of models to learn from and be wary of around the world. I mean, certainly plenty of sovereign wealth funds are pretty bad in a lot of ways. So public is not a catch-all for good. And that's, I think, a really important point to bring in here.
Yeah, Mike, you have a point to add?
Yeah, very briefly, because I see Pinar has his hand up. I wanted to ask Lenore about the pots, because it seems to me that the public asset manager is basically premised on essentially exit. Like the idea is that you would want pension funds and other institutions to exit their institutional investors and go to the public. And I guess I'm curious, is there any possibility for a voice strategy within the large asset managers? And if so, is there any organizing around that? Or
you cut out at a key moment. Is there any possibility of a
voice strategy? So are there large pension funds that are having their money essentially managed by these asset managers that are thinking about, how do we use our stake in this ETF to sort of to push around, or however you want to think about it, the leaders of it?
Absolutely. I mean, there's lots of groups right now. I can name a couple of shareholder commons, others who are trying to directly use their own strategies to move asset managers. There's also been a really interesting development that I'll find a link when I stop talking, where BlackRock and now State Street have put out new policies where they actually are going to devolve voting decision-making back to the public pension, or back to their clients, to the pension funds or corporate pension funds, because they're, I think, getting so much heat that they don't want to be responsible anymore. But, something I didn't mention that's also really important to, have in the mix here that I'm sure many people know, but, the majority of the fees that private asset managers, these big behemoths, get is from corporate pension funds. Therefore, they have, intense contradictions even within their own, even within the system we've got, in terms of thinking about their role as fiduciaries and shareholders voting. And at the same time, their profit motive is to keep corporate management happy, because that is where they get the majority of the assets that they manage. So there's, I think, so many contradictions, but the move that they've made, both, I think, as you mentioned, and I mentioned, for people who are watching this stuff, this sort of fake uprising of, Republican state fiduciaries to say, asset managers are, the woke left now, they are, ESG is going to be the end of civilization. And at the same time, the move from for asset managers to try to get rid of their own voting power, it just calls into question, what are they doing? How would they justify their existence if they devolve that voting power? And, again, for me, how does it show this whole system of shareholder primacy is just simply justifying, the continuation of, elite extraction of profits? This is sort of nothing new under the sun there, but it's justified in a new way that we have to combat. So I went a little bit afield from your question. There's a lot of good organizing that I could talk about offline.
Okay, let's take one final question from Pinar Bedranoglu.
Yeah.
Pinar, feel free to ask away.
Okay. I can't turn on my video, but I mean, you can hear my voice, I suppose. Thanks for those quite important presentations. Indeed, these are really important questions to pose. But my question will be more about methodology, and because Michael started his presentation by first of all situating himself in a sort of a distance with that feudalization thesis, and the feudalization thesis or that sort of arguments tend to highlight a sort of a break, a sort of fundamental change in the way that global capitalism has been managed today. Okay, so I wonder what does your political plunder argument tell in contrast to this or following this discussion? Because I mean, definitely you talk about the political plunder of finance capital, particularly in its practices today. But I wonder whether, for instance, the so-called productive capital has ever been non-politically plundered. And I mean, I'm asking this question, and definitely, I mean, finance in the let's say 19th century, late 19th century, it was also possibly equally plundering the world politically, because in those times it was really hard to differentiate finance from the powerful Western countries in overall. So my question is, can we discuss this analysis without really discussing the powerful capitalist countries, their specific state policies, because contemporary, in a sense, significant, let's say, expansion of finance can definitely be understood without the US policies specifically. I mean, since...
Oh, okay, I think we lost her there. I'm going to ask one more on that, which is, you know, as concepts become popular, they lose their historical specificity. But yeah, Lenore has to take off because it's Halloween here in the United States, speaking of historical specificity. So at some point, one has other duties on Halloween. But one more point I want to ask Mike, actually, because instead of Hilfreding, I'll bring up Hegel. Because, you know, it seems like we're moving away from decades of easy monetary policy, which has allowed finance, you know, to engage in these policies of redistribution upwards in an economic environment which is historically different than previous environments in the world economy, both in terms of interest rates, relationship between financial sectors and corporate sectors, et cetera. And it seems like that era, at least temporarily, is coming to an end. There's no sign of easy money. And one could foresee a future where the interests of the financial sector actually go against the interest of the manufacturing sector, even more so. Or I mean, there are schisms within both sectors are actually at odds, whether in the United States or elsewhere. So this kind of goes along with Peanut's question, which to a certain extent, some of the concepts that we've developed, or at least debated over the last 20 years, might be historically specific themselves. But second, and back to this question of I think predation and finance, that, you know, the way that the left has dealt with financialization and the way that, you know, you worked on it, many of us have worked on it, really dovetails with this shift from finance being, you know, handmaiden and helper and conduit and efficiency machine to a kind of way of actually pushing back against other forms of political change, right? And so maybe as you're addressing Peanut's question, also, can you wax poetic about how, if we do enter this kind of new moment where, you know, kind of global recession looms on the horizon, and, you know, state monetary policy is actively attempting to, like, you know, pull the economy back down, that, you know, will that change the way that we talk about finance?
Both very very deep and big questions. And my talk might be a bit of a Owl of Minerva situation here. But yes, to Pinar's comment, Yeah, on the feudalization thesis, it's not the debate isn't one I've really contributed a whole lot to, but in general, I would want to distance myself from the view of some kind of decisive break or some sort of new mode of production, which I think sometimes certain perspectives in that debate kind of seem like they're leaning towards, and I think that's a bit of an exaggeration. I think the argument I would make is that historically specific conditions within contemporary capitalism incentivize a shift into sort of into political plunder. That is, it is a capitalist. It is, the feudal logic of extraction through politics today is a result of the configuration of capitalism today, as opposed to a replacement of capitalism or something along those lines. And I guess I should just kind of specify that I'm using plunder in maybe a far too restricted and narrow sense. I think most people would recognize that the meaning of the word doesn't just relate to politics or sort of what happens within the state. You can plunder your neighbor's house, but the way I'm kind of thinking about it is like specifically through political mechanisms and specifically through political processes, as opposed to market relations or something like that. So I don't know if that really gets to the kind of deep breadth of your comment, but that's kind of how I come at the issue. On Kevin's comment, I think that's a really interesting question, which I don't have a great response to. I would just say that we seem to be living through. You asked me to wax poetic, so we seem to be living through a few decades of extraordinary financial crisis and ups and downs. Decades that I think have deeply weakened the popular legitimacy of the financial sector, but have nonetheless not weakened the political power of the financial sector. And so that to me, I think, is kind of like the core contradiction of the moment that we're living in. On the one hand, I think most people recognize the financial sector as broken, which is precisely why the anti-finance discourse is mobilized by everyone left, right, and center. But on the other hand, despite that sort of loss of cultural legitimacy, those means of plunder that I kind of pointed to, nonetheless retain finance's political power, such that politics reflect in some deep way financial interests. So that the question now, though, of a shift in sort of in central bank monetary policy against sort of these historically low interest rates raises a real kind of, raises real questions about sort of the durability of that. And it also raises questions, I think, of the political power of the financial sector. Like, why would central banks be engaging in practices that are explicitly hurting financial markets? And to that, I'm not sure. I'm not sure what the sort of historic reconfiguration will look like. I mean, I'm just, we're constantly going back to the Volcker shocks, but the Volcker shocks, which essentially pursuit of similar policy. It seems like we're kind of following a similar path today. Were extraordinarily beneficial to finance in the long run once it got once they sort of were able to contain the kind of the price of the dollar, it was extraordinarily beneficial to finance. And if in a kind of interesting way, when you look at the debates about the Volcker shocks and you look at the sectors that were most supportive of it, in fact, it was the financial sector. It was banks. It was particularly people that were financial actors that were embedded in international financial markets. And so I'm not sure that like a recession kind of reconfigures the power of finance today. I think it might just might simply restore it in a way. But yeah, that is knowing what's going to happen there is way out of my pay grade.
All right. Well, thanks, Mike. All right. Well, thanks to everybody who attended, asked questions, and to Mike and Lenore, and to Bob Brenner and Rohan Advani, our center organizer. This is going to be online. Also, if you haven't signed up to our listserv, you can do that. We have a website. Also, I think online we'll have various links to sign up for the rest of our talks this year. So thanks to all, and appreciate the questions, and looking forward to a whole year of events.